Welcome to our video, Accounting 1, Financial Ratios, Part 1. Disclaimer to our users. These notes are intended for informational purposes only. Due to the abridged nature of the accounting notes being presented, these notes will not cover all topics extensively. Students, please use these notes in conjunction with your textbook and coursework. The Bookkeepers Accounting Services MD, its employees, and affiliates are not responsible or liable for any misuse of the information provided in these notes. What are financial ratios? Financial and/or accounting ratios are tools used to compare financial statement information to assist in examining an entity's financial strengths and weaknesses. Let's take a closer look. The first set of ratios we will discuss are considered liquidity or short-term solvency ratios. Here on the left-hand side, we have an example of our basic balance sheet. This will help us extract the numbers we need to solve the ratios we will discuss. The first liquidity ratio we will discuss is the current ratio. This is calculated by dividing current assets by current liabilities. This essentially tells us how liquid an entity is on a short-term basis and tells us how likely we are to have enough cash and other assets to pay our short-term debt. The next ratio is the quick asset ratio. This is calculated by subtracting inventory from current assets, then dividing it by current liabilities. This measures the amount of current assets for each dollar amount of short-term liability, also known as current liability. The next ratio is the cash ratio. This is calculated by dividing cash by current liabilities. This basically tells an entity if they have enough cash to cover their current liabilities. Now let's dig into the numbers. On the left, we have our balance sheet once more, and on the right, I've plugged in the numbers from the balance sheet that equate with the ratios from the previous slide. As you may notice, there's a note under the quick asset ratio. Because our balance sheet did not include an inventory account, I did want to give an example that showed the effect of the inventory account. So if we did by chance have a balance sheet account for inventory in the amount of $47, you see how the answer for this ratio would change from 2.06 to 2.02. The next set of ratios we will discuss are financial leverage ratios. On our left-hand side, we have our balance sheet example. This one is a more extended version of the balance sheet necessary to solve these ratios. The additions to this balance sheet are the long-term assets, which include plant, property, and equipment, as well as land. And another addition is the long-term debt category underneath the liabilities. The total debt ratio is calculated by subtracting total equity from total assets, then dividing it by total assets, or dividing total debt by total assets. The total debt to equity ratio is one of the financial ratios that evaluates financial leverage to help assist in figuring out financial risk. The next ratio is the debt to equity ratio, which is calculated by dividing total debt by total equity. The equity multiplier is calculated by dividing total assets by total equity. And lastly, long-term debt ratio. The long-term debt ratio is calculated by dividing long-term debt by long-term debt plus total equity. Now let's dig into the numbers. As you can see on the left, we have our balance sheet once more, and on the right, I have plugged in the numbers to show the effect of each ratio. One thing you may notice as a difference between liquidity and financial leverage ratios is the way that they are presented. Liquidity ratios, the answers are presented as straightforward numbers, whereas financial leverage ratios are presented as a percentage. The reason they are presented as a percentage is because they are evaluating financial risk. So essentially, the higher the number, the more risk the entity presents. And when it's being evaluated by outside third parties, the higher the risk, third party may want to back up. For example, the total debt ratio is 62%, whereas the long-term debt ratio is 42%. Depending on the type of information needed by the third party, that could be good or bad. Questions? If you have any questions or comments, please leave them below. We respond to all comments. Thank you for watching our video and stay connected with us via social media.